So you have a few views that are a little contrarian, but on the Fed, this was the whole thinking before Jackson Hole, is that buy stocks, inflation peaked, the Fed will pivot. Jay Powell totally shut that down, and he's done it now twice in the last few weeks. It doesn't seem like the market likes that.
Well, I just don't believe him, and I think what's important. Well, I think what's more important for stocks is whether CPI has peaked or not. Historically, if you look at all the other inflationary cycles, when CPI peaks, equities usually rally. The only two times that hasn't happened was 2008 and 1937, both very, very deep recessions. And so I just don't believe that the Fed wants to engineer one of those type of recessions. And so at some point next year, as CPI comes down, they'll be able to have the political capital to simply slow down the pace of hiking, which at 5-4% CPI is a form of a Fed put.
I was just going to say that what if it slows down to 5-4% of PPI, which is still more than double what the Fed is targeting? They're still talking about a 2% inflation target.
So that's the part that I just don't believe, that they want to get there in 12 months. If they do, if I'm wrong, then we're going to have a calamitous recession. And the truth is,
they'll just have to keep tightening and tightening and tightening.
That's right. And look, I mean, electoral cycles matter for the Fed. The Fed has rarely raised interest rates aggressively 18 months out to the general election. And so that's something that we need to start thinking as well as next year comes into the forefront.
So are you bullish?
On equities, yes, provided that the view that CPI has peaked is correct. And so a lot of that will depend on oil price, which of course is a function of not just demand and supply, but also geopolitical risks, which have to dampen down over the next 6 months if you're going to have further decline in oil prices. And that's what's interesting about this cycle. Oil price stock correlation has completely pivoted. It used to be basically positively correlated. Now I think it's negative. And so oil prices have to continue to be either flat or have downside.
Well, because now weaker oil prices are a function of the slowdown in China and Europe and potentially the U.S. as well.
That's right. But also, when oil prices go down, they tell you something about the Fed reaction function, which they didn't in the last cycle. Last cycle, oil prices go up or down. You're not thinking about the Fed. But when Jay Powell said on June 15th, I'm looking at headline inflation, that means that oil prices matter for the reaction function. And so yesterday was a good example. Oil prices collapsed like 6%. But what happened to the stocks? It was a good day for stock market.
And you think that was why?
I think that's going to be increasingly why. I mean, it's one day data
also,
point.
Also, bond yields came down.
So exactly. Well, that's all part of the same story, right?
So you think the Fed's going to stop hiking and actual cutting next year?
So that's a very important point. What does a Fed put look like in a world of 4% CPI? Because hiking or cutting is actually not relevant. What's actually relevant for us as investors is our real yields going up, down, or sideways. They've gone dramatically up. But in a world of 4 to 5% CPI, you don't actually have to cut to get the real yields to stop appreciating. You just have to hike less. And so to me, if they go from 75 to 25 basis points, they're still hawkish. They can still politically say, hey, we're dealing with inflation. But they're actually creating a Fed put. So
we also have QT going on, and that's ramping up. That's trimming of the balance sheet, and a lot of people are worried about the impact that's going to have on markets.
So ironically, what's the worst thing that can happen to the stock market? Bond yields go up by a lot. What QT does, interestingly, is it actually reverses what QE did. And QE basically made you sell bonds, buy stocks. QT reverses that. And in a way, yes, that's a headwind to stocks, but actually keeps bond yields dampened, allowing the stock market to do okay over the next 12 months.
I also want to get to Europe with you because I can't find anybody that wants to invest in Europe right now. They have this ugly combination of very high inflation. Now they're going to have a rate shock, on the precipice of recession if they're not already in one, and this looming energy emergency. Well, how is that attractive to you?
So markets are forward-looking. And so what I would say is that the market has currently priced in a pretty dire scenario in Europe, which includes a recession, which includes an energy crisis. We know this. Look, the euro is at parity. Let me just remind something, the viewers. I mean, euro wasn't at parity during the euro area crisis when the very existence of the asset was in question. So that's like a lot of the bad news has been priced in.